Hello and welcome to Calmvestor podcast. I am Ethan. Join me on this journey to build solid financial thinking and take control of your financial future. Have you ever wondered what really stands between you and potential financial chaos in the markets? Imagine a time like the 2008 financial crisis. Many lost their homes and savings. A key reason was weaknesses in financial regulations. Or consider the more recent collapse of FTX, a major cryptocurrency exchange. It left many investors with significant losses and raised urgent questions about how digital assets are or are not regulated. These events are stark reminders of how powerfully market rules or their absence can affect everyday investors like you and me. It is not just about big institutions, it is about your hard-earned money. Warren Buffett once said, "Risk comes from not knowing what you are doing." Understanding the regulatory landscape is a huge part of knowing what you are doing as an investor. It is about recognizing the protections and the pitfalls. So do regulations truly protect us, or can they sometimes be a barrier? And what happens when these rules cannot keep up with the fast pace of the market? Let us explore this vital topic. First, what exactly are market regulations? Think of them as the rules of the game for the financial world. They are laws, rules, and guidelines set by government bodies like the Securities and Exchange Commission or central banks. Their main purpose is to protect investors, especially individuals. They aim to ensure markets are fair, transparent, and efficient for everyone involved. This helps build trust in the financial system. Regulations also work to prevent fraud, market manipulation, and other misconduct. Ultimately, they contribute to the overall stability of the financial system, which benefits us all. Without them, it could be a free-for-all. Think of it like traffic laws. We need them for roads to be safe and orderly. Similarly, financial markets need rules so participants can operate with a degree of safety and predictability. It is about creating a level playing field. However, these regulations are not always perfect. Sometimes there are gaps, or what we call loopholes, and sometimes the rules themselves can create unintended problems. No system is foolproof. So what happens when regulations are problematic? If rules are too loose or poorly enforced, the risk of fraud and scams increases significantly. We have seen this with some unregulated initial coin offerings, or ICOs. Lack of regulation can also mean a lack of transparency. Information might be hidden or misleading, making it incredibly difficult for you to make informed investment decisions. You are essentially investing in the dark. In such environments, markets can be more easily manipulated by large players, often called whales or sharks, at the expense of smaller investors. This undermines the fairness that regulations are supposed to ensure. Furthermore, complex and risky financial products might be introduced to the market without adequate warnings or explanations, trapping unwary investors. The allure of high returns can mask significant dangers. On the other hand, regulations that are too strict or outdated can stifle innovation in the financial sector. New, potentially beneficial products or services might struggle to emerge. This can limit your investment choices. Excessively tight rules can also increase compliance costs for companies. These costs might indirectly be passed on to you, the investor, through higher fees or lower returns. There is a delicate balance to strike. And what if regulations change suddenly? This can create market instability and uncertainty, causing anxiety for investors. Long-term investment strategies can be disrupted overnight. As Warren Buffett also noted, in the business world, the rearview mirror is always clearer than the windshield. The negative consequences of flawed regulations often only become obvious after the damage is done. So why is it so challenging to get regulations right? One major reason is that financial markets are constantly evolving. New products and technologies emerge rapidly, making it hard for rule makers to keep pace. Think about the rise of cryptocurrencies and decentralized finance. These innovations have presented entirely new challenges for regulators worldwide. It is like trying to build the plane while flying it. The complexity of many financial products is another factor. Some are so intricate that even experts struggle to fully understand them, let alone individual investors. This complexity can be used to hide risks. Then there is the influence of lobbying. Powerful financial institutions often spend significant amounts to influence the creation of laws and regulations, sometimes not in the best interest of the average investor. Regulatory bodies may also lack sufficient resources or specialized expertise to effectively oversee an increasingly complex financial world. Proper monitoring and enforcement require significant investment. Finally, the globalization of finance means capital flows freely across borders. This makes it difficult for individual countries to regulate effectively on their own. International cooperation is key, but often hard to achieve. Greek philosopher Heraclitus said, The only constant in life is change. This certainly applies to financial markets and the ongoing efforts to regulate them. It is a continuous adaptation. Given these challenges, how can you, the investor, protect yourself? The first and most crucial step is to enhance your knowledge and conduct thorough due diligence. Do your own research. Actively seek to understand the regulations related to any investment you are considering. Read official documents and stay informed about pronouncements from regulatory agencies. Do not just rely on hearsay. Understanding your rights and responsibilities as an investor under the law is also vital. This knowledge empowers you to identify red flags and take appropriate action if needed. The second key strategy is diversification. As the saying goes, do not put all your eggs in one basket. This is especially true for new or poorly regulated investment areas where risks can be higher. By spreading your investments across different asset classes and perhaps even different markets, you can reduce the risk of a single regulatory issue severely impacting your entire portfolio. This is a core principle of sound investing. Third, be extremely cautious with promises of guaranteed or exceptionally high returns, particularly from new or unfamiliar products. If it sounds too good to be true, it probably is. High returns often come with high risks, especially when an investment is not well understood or clearly regulated. Be alert to signs of scams, unrealistic promises, pressure to invest quickly, and a lack of transparent information. Always prioritize investing through reputable, licensed, and well-supervised financial institutions and platforms. Check their credentials and regulatory status before committing your funds. Optionally, consider leveraging technology and professional advice. There are tools that can help you analyze information and assess risks. Do not hesitate to seek guidance from trusted financial advisors who understand the regulatory environment. Remember Benjamin Franklin's wisdom: an investment in knowledge pays the best interest. Educating yourself about finance and regulations is one of the most valuable investments you can make. For instance, a prudent investor might thoroughly check the operational license of a brokerage firm before opening an account, or they might allocate only a small, carefully considered portion of their portfolio to a newer asset class like cryptocurrency after extensive research. Market regulations are a dynamic and ever-evolving aspect of the financial world. As an investor, your continuous learning and adaptation are crucial for navigating this landscape successfully. While regulations can have their shortcomings, your understanding, diligence, and caution serve as your strongest line of defense. These qualities empower you to make smarter decisions. Investing is not just about seeking profits. It is a journey of continuous learning and personal development. Each piece of knowledge gained makes you a more capable and resilient investor. Aim to be an intelligent investor, one who not only follows the market currents, but also understands the underlying rules of the financial ocean. Be proactive, not reactive. As Malcolm X said, the future belongs to those who prepare for it today. Preparing yourself with knowledge, including an understanding of regulations, is key to securing your financial well-being. So right after this podcast, perhaps take a few minutes to look into a specific regulation that affects an investment you're interested in. Knowledge is power, especially in finance. If you found this discussion helpful, please consider sharing it with other investors you know. Spreading financial literacy benefits everyone. Thanks for listening. If you found this content valuable, do not forget to hit like and subscribe to the channel. See you in the next episode. Have an amazing day filled with positive energy.